So welcome everybody. My name is Jenny Casson. I'm the chair of the board of Crowdfunding Professional Association. And we're going to be talking today about how the Federal Jobs Act and crowdfunding legislation got started. And our guest, Woody, and I were both very involved in that. And so we want to just share a quick history, just so you know kind of what it took to get it done. And then Woody's going to share a lot of information and interesting updates about like where we are now, because it has been almost 10 years now. And it's really interesting to see how far we've come. So I'm going to start by presenting my experience helping to get the Jobs Act passed. So I'm going to share my screen. All right. Okay. So you can see that, right, Woody?
Yes. Yep.
Cool. Okay. So back in 2006, I was actually working at a nonprofit doing community economic development, but I got invited by a securities lawyer to join him in starting a law firm. And this is just the only picture I could find from that time. This is the team that we had back then. We had an awesome team. We had a great office in downtown Oakland. It was called Cutting Edge Capital. It had other names too. There was a time we were calling it Katovich and Casson Law Group, K2 Law, Cutting Edge Counsel. But basically, we just really wanted to figure out how to help more people raise money from their communities within the law that existed at that time. And we knew it was possible. I was very new to securities law, so I started to just really try to figure out, like, how do we do this? So one example that I had heard about and found out more about was that in 1984, Ben and Jerry had raised about $750,000 by offering stock in their company to residents of Vermont. Like a large percentage of the population of Vermont ended up investing. I had heard of some other examples of companies that had done it. This shows a few of the other companies that had done it. So again, I knew it was possible. I needed to figure out how. And I started to research and I realized that there was a way to do it. You had to do state by state compliance, securities law compliance. So I started working with clients. This is one client that I helped to raise money. A California company that registered under California securities law. This was a company that I helped to raise money. They registered under Vermont and Massachusetts law. This one registered under Washington law. This one registered under California law. We even raised money ourselves. Because we had seen many of our clients do it, we went ahead and did it ourselves and registered under California law. So around 2009, I co-founded, I was still running this securities law firm, but around 2009, at the end of 2009, I co-founded a nonprofit called Sustainable Economies Law Center with another attorney named Janelle Orsi. This is a horribly blurry picture of our first summer. We invited interns to come work with us in the summer to work on legal issues related to supporting community economic empowerment. And two of our interns, the ones on either end of this picture, um, helped us draft a letter to the Securities and Exchange Commission. Actually, that's kind of getting ahead of the story. Okay, so this is an article that I wrote in a local newspaper sharing what I had learned. This was in January of 2010, sharing what I had learned about how it was possible to raise money from your community. Someone named Paul Spinrad, who at the time worked for a magazine called Make Magazine, read that article and he contacted me and he said, I found out that it's possible to submit petitions to the SEC. Maybe we could do that and ask for a change to the law. So he ended up raising money on Indiegogo, which is a rewards-based crowdfunding platform, to fund our work to do this. And so we ended up raising $1,321, which isn't a lot, but it was helpful. And so, a bunch of people contributed to fund this mission of ours to try to change the law at the federal level, because even though it was possible at the state level, it was a real hassle having to deal with each state, and some states were very challenging. So that summer, those two interns at Sustainable Economies Law Center wrote this petition to the SEC requesting rulemaking to exempt securities offerings of up to $100 per investor. So this was like our early idea of what it could look like. What if people could invest up to $100? Surely the SEC wouldn't have a problem with that. So we submitted it in 2010 on the platform that the SEC has to submit petitions. This is a picture of it. The SEC chair at the time was Elizabeth Murphy. We got about 150 letters of support on the SEC website, which is, I think, was a record. We were interviewed on the radio. It came up at the SEC's Forum on Small Business Capital Formation, which interestingly, that's coming up in a few weeks, the annual Forum on Small Business Capital Formation. We got more media coverage in other places all over the country. And then this guy that I had never heard of before, named Woody Neese, heard about the idea and started this website called startupexemption.com to advocate for this idea. And for some reason, and Woody can maybe share the story of how it happened, but Whoopi Goldberg became like a big advocate for it. So of course we heard nothing from the SEC. They're like, whatever, like they're notorious for ignoring these kinds of proposals. But I think Daryl Issa wrote a letter to the SEC chair, who had now changed to Mary Shapiro, and asked her about, like, why is it so hard to do capital formation in our country? And she did reference our petition in a footnote. So she was at least aware of it. And she did mention, like, the petition has received almost 150 comment letters, all in favor of the creation of such an exemption. Let's see. Yeah. So she really had no interest in actually doing anything about it, but she did acknowledge it. Then, amazingly enough, we got support from President Obama. He started talking about the importance of boosting access to capital, and he talked about unlocking the capital through small regulatory changes. And then it passed. Oh my God, it passed the House. It was so incredible. Look at this, how bipartisan it was. There were only 10 no votes in the entire House. So we were so excited. And that version of the law was very short. It really would have been a nice thing if that is what it ended up passing. Unfortunately, the Senate made some last minute changes in the name of investor protection that will make it, I say will, because I made these slides before it actually went into effect a long time ago. Boo, Senator Merkley. He is the villain in this situation, I will say. But Woody and I were both at the signing ceremony on April 5th, 2012, and it was the Jobs Act, which included more than just the Crowdfund Act. The Crowdfund Act was Title III of the Jobs Act, but there were some other things in there as well, like the authorization to create Regulation A+, which, before that, you could only raise up to 5 million under Reg A. So that's my short history of how we got here. So Woody, take over and tell us, you could share a little bit about that time period, but then tell us what's happening now.
Yeah, I
I'm
think
going to go off camera. Well, I'll stay on camera if you want to chat
okay.
for a minute.
No, I mean, I think for this part, I think it's sort of fun because it's fascinating how, it's ideas at the same time percolate. And so I was living in DC. All my friends worked on Capitol Hill. Even though I was an entrepreneur that had started a business that had nothing to do with politics, I understood what it took to start scale venture fund because I was a venture funded business and exit it because we had an exit. And I knew how I created jobs. And so when my friends on the Hill were like, we need jobs, and this was, of course, during the Great Recession, I was just like, well, if you guys made it easier to access capital, then we wouldn't have these issues. And so that was like my entrance into it. And so, how it's fascinating how we both came to the same thing from different perspectives, but all with the eye on access to capital. And what it's turned into is just something I think amazing because I can speak for myself. I don't, and I'm sure the slides will speak for themselves too, but I don't know if you had any idea when you and your interns were talking about this, if you would have thought at least 40% of the issuers that would be raising money would be women and minorities. That
I
this
hoped
would
it
be
would be a lot more than that, but yeah.
I mean, but when you looked at the 2% that was, happening in Silicon Valley, and I knew this because we were a venture funded firm, um, that, this could be an answer to, that whole problem that existed in the private capital markets. So, it was a super cool experience for us. It made it super easy that I knew people in Washington, D.C. Karen Kerrigan gets a lot of credit for this happening because while I had a lot of friends on the Hill, Karen Kerrigan, who's the president of the Small Business and Entrepreneurship Council, literally navigated our way through the different offices. Um, we did that Charlie Brown rally on the mall that had every single representative and senator's office that was part of the legislation stop and say, come into our office. And that made a huge difference in terms of turning this from an idea as well into the bill. I do remember how funny it was when they called that first hearing where I testified at that first hearing, and then the White House called me afterwards, and I thought it was a joke, so I hung up on them because I thought it was a friend pranking me. But that was the White House, literally saying, we think what you're doing has merit. And so, it was amazing to work with them on this, particularly when it was Republican led. Like, Darrell Issa, I remember sitting in the chambers with him talking about what they were going to send to the SEC in terms of the letter. And what it is that we wanted to do, and so we had to craft those questions carefully to the SEC to get the responses that we were looking for. Um, but it's, Washington is a sausage making facility. And to your point, Jenny, like it would have been, I mean, even when we were talking to Patrick McHenry, who was introduced the bill, this 8-page framework just is not going to fly. And he's like, listen, it'll change when it gets to the Senate. And then, of course, when the SEC is done with it, it's going to look a lot different as well. And it was what, 485 pages when it was done. So, um, I was happy when it came out. I don't know how, I was just thrilled that we've got a starting point. Like it wasn't perfect. Yes, sausage, compromise had to happen. And I remember being in, what was it, Senator Brown's office talking to Marnie. I don't remember Marnie's last name. And she's just like, NASA, the state regulators was just in here before you, and they're completely opposed to what you're doing. And I'm like, why? This is just going to create jobs in all their states. And they're like, well, they're there to protect investors. And I was like, yeah, but we got a whole framework to protect investors. And they're like, yeah, they're not here for that. So it was a fascinating thing to be a part of. It was super cool that day when we were at the White House to be sitting there thinking, what is this going to be? And to be here 10 years later, where you and I have, what is this stuff in our hair now? I mean, I don't like this color. I'm just kidding. The gray, the gray. um how we've been able to have we been part of this ever since. So I was interviewed on Bloomberg Television right after I left the White House, and they were like, wanted to know what this means to startups, and they wanted to know what role I wanted to play. I had started on Wall Street, and I went to Silicon Valley and worked for a database company over there. And so I understood the importance of data, and I always from the beginning just wanted to be involved in the data side of things. And so we built an aggregator that collected information on all of these companies and every single offering from the minute the industry launched. And so what's been great about that, And if you follow me at all on LinkedIn or anything, you know I just sort of write about this industry. We operate with a very lean team here. We're all very passionate about what we do, and we're all data geeks. But I know in my heart of hearts that the data will help drive this industry forward. It will help drive the changes that I think will be beneficial to the industry. And that's really what I want to talk about in this presentation today. So let me share this screen and hopefully, let's see, let's just shrink my face down over here because you don't need to see that. And then I'm pretty sure you can see me. Oh yeah, I can see it down at the bottom. Okay, so it's just crazy to believe that this has been 10 years since this became law and over, more than nine since it went live. I really just want to walk you through what's happened over the past decade, not based on anecdotes and headlines, but really on the hard data. So everything that you're going to see is drawn from our full C-Clear data set. It covers every single regulation crowdfunding offering from 2016 through 2025. One of the things that I talk about when I talk about this to institutional investors, to academics, to a lot of to Washington and regulators and people is you all operate on a data set that consists of Edgar. Okay, so it consists of what's been filed, what's been disclosed in terms of updates. So if they do disclose an update, how much they raised and any annual reports. But what you miss, which is what we collect and what actually Brian and King's Crowd does a really good job of collecting as well, is investor sentiment and issuer sentiment. And the two things that we collect there are every day we look to see how many checks are deployed into these offerings and the aggregate amount of those checks. And so what you can see, not just in terms of like a pitch book or a Crunchbase, which is how much did a deal raise in a round, but what's hot over time. You can look at these offerings and you can actually see which offerings are getting traction, which ones are cooling down. You can look at industries and see which industries are hot, which ones are cooling down. And there's a lot more that you can learn about at a granular level than you could when you just look at what happens in the venture capital market. And so this is a data story. It's about growth. It's about maturity. It's about where the market really stands today. And I think that it's super, super exciting. So like I said, this presentation's every single Form C filing. I'm just going to focus on Reg CF, by the way. I'm not going to talk about Reg A. I am going to mention parallel offerings because I do look at this from the point of view of when I had my company and I raised venture capital. We talked about a round of financing, and a round of financing includes, both in this case, what I believe is a Reg CF offering and a 506C offering if they are concurrent at the same time. And I think it's important in a couple of slides, and I did break it out so you could see what's happening over time for you to see how the 506C side, the accredited investor side of investment crowdfunding, has sort of picked up over time. But we collect about 150 data points per issuer. We've got over 5 million data points in our entire database. So it's gotten pretty comprehensive, and we update this on a daily basis. So what you're seeing isn't a survey of data or samples, it's really the full market. And that's important because people often talk about regulation crowdfunding like in broad strokes, and so I just want to replace opinions with evidence. That's really what I want to do. I get very frustrated when people just sort of toss out their thoughts out there without having it based on any data. And if you do follow me, you'll notice that I do speak up when people are just throwing out their opinions there without anything to back it up. So let's just start with the simplest measure of this industry, which is dollars raised. Um, uh, Collectively, since the industry got started, we've recorded about over $3.2 billion in investments. In 2016, the first year that this got started, the market raised about $20 million. So if we fast forward a decade, we have had multiple years that have exceeded $400 million. with peaks over $500 million. And like I said, when we talk about the parallel investments, that's the light blue area that you're seeing that really started to pick up steam. It started like in 2021, we noticed, but it really started to pick up steam in 2023, and 2024 was really a breakout year for that. If it weren't for those parallel investments, we would have seen a pretty big drop off in the investment crowdfunding space. So it's been a really important part of helping keep this industry up and going. And so I like to point at this slide from those 2 points, which is it's scaling, it's gone from an experiment to permanent capital formation. We've shown how we can be responsible with capital in terms of scaling, and now we are getting the interest of the accredited investor side in the deal. And I think that's a really important part of this conversation. If I let's see, I need to make sure that you guys can see this whole screen here. Do do. All right. Let me go to the next slide. Let me see if I can shrink this down. All right. So oh, here we go. I think you can probably see that a little better. All right. So now if I'm talking about filings per year, we talk about the activity in the space. In the very early years, there were just 200 successful offerings. At the peak, we saw more than 1,600 in a single year. That's roughly like a fivefold increase in issuer participation. So what this has told us as well is not only has more money flown into the marketplace, but more companies are choosing Reg CF as a viable option. So that's great, but we've seen how things have changed over the last couple of years. And one of the things that we've noticed in our research is there are parallels between what happens in the venture capital marketplace and what's happening in the regulation crowdfunding capital markets. Um, with the collapse of Silicon Valley Bank in about what was that 2022, 2023, there was this pullback by venture capital in terms of investing in early stage companies. They moved upstream to less risky deals if they were investing at all. And that's had a trickle down effect. I think that trickle down effect is seen in a few ways. It's seen in people's feeling like, is this the right time for me to be investing in these startups if VCs aren't investing? So there was a pullback in venture capital investing in the space. There's a pullback with investors in regulation crowdfunding investing in the space. And I think that has had an effect on issuers going, this is not necessarily the right time for me to be raising money. So we've seen less issuers come into the marketplace as well, which clearly is evident in what you're seeing in the 2025 figures right there. So while there was that 5x increase in participation in from the beginning to the peak, we're seeing a drop off. I do believe, like I've had many conversations with people that study the private capital markets. I'm actually going to an event in Spain in April, speaking about this. And a lot of what we hear is there are cycles for markets. And I believe we are going through a cycle right now, which is this down cycle where we've got fewer deals. People are wondering if this is the time to be investing. When the capital markets ease up for this segment of the marketplace, yes, I do believe more issuers will be coming in. I do believe more capital will be coming in. And so, well, this is just the nature of an industry. This is the nature of these markets. And it's a cycle that we just have to get through, which I believe we are doing right now. All right. So if I move to the next slide. All right. One of the things I like to point out is when this industry got started, it was a very different industry from where it is today. The issuer maturity has shifted dramatically. And that's, I think, the really interesting part of the story, which also proves why this industry is working. In the early years, most of the issuers were pre-revenue startups at the very early stage of companies' ideation. They are testing an idea. And if you look at that top line there, 61.3% of the companies in 2016 were pre-revenue. Now, if you fast forward to 2025 or these past few years here, you can see like over 60% of them are post-revenue. So it's a completely reverse. In the beginning, two-thirds of the issuers were pre-revenue. Now two-thirds are post-revenue businesses. That's a fundamental shift. It started in 2016, like I said, as a tool for concepts and prototypes, but it really has evolved into a tool for operating companies with real customers and real revenues. This can be supported by this slide right here, which is the average age of companies. So we look at these companies from when they filed with the SEC and their date of incorporation. And when the industry first got started, 74.2% of them were startups. So they were less than 3 years old. Now you can see at the bottom, we've got over 50% of them are established. So they're over 3 years old. So that means more uh, businesses with more longevity have been in the marketplace, they're more mature, and now it's being used across a much broader business spectrum than it was before. So, those two slides together tell you what I believe is the fundamentally important part of the evolution of this marketplace over time, which is when it started, there were a lot of risky companies in the marketplace. Now that we've got mature companies that are post revenue, that which means that there's a customer buying their products or services, we've got less risky companies in the business. And I think that is good for investors that are coming into the marketplace because when you're making these investments in these companies, it's really important that you have a diversified portfolio. So it's important that you look at companies across the spectrum, ones that are high risk and ones that are less risky. And I think you get that good blend in there. And this plays into what I'm going to tell you at the end, which is where I believe the industry should focus and some changes we need to make because we've got more established and less risky companies in the marketplace. So if I go to the next slide, which is talks about the average raise per slide, this is really talking about how much companies are actually raising. So when you look at what happened in the beginning to what's happened now, the average raise size has more than doubled over the life of the market. Recent years show that the average is well above $600,000. And this reflects several things. First, I think a lot of this is due to the cap that went from 1 million to 5 million in 2021 that increased the amount that issuers could raise. Because now companies that needed to raise over $1 million came in. They were part of this cohort of companies that were less risky, more established. Post revenue, and they needed more capital to help them scale. So it was a different type of company coming into the marketplace. They're more mature. Also, I think the evolution of the platform plays into this. In the beginning, there were just a handful of platforms. Then we had more platforms come into the marketplace. If you look at the entire number of platforms that includes broker-dealers and funding portals that have registered with the SEC and are overseen by FINRA in this place, there's been about 150 of them. But clearly, the top four, WeFunder, Start Engine, Republic, they're like the big guys that own the majority of the marketplace. But they've evolved as well. And I think that's brought more, better companies into the marketplace on their platforms, which has allowed them to raise more money. But the last part of it is, I think the type of investor that's come in has evolved as well. In the beginning, we had this parallel between donation and rewards-based crowdfunding, which is a bunch of small donations or, buying a token of appreciation in a company. Then we evolved into these are you're owning a stake in this company or you're borrowing money. The company's borrowing money from you and you'll get paid principal and interest through a simple debt offering. This attracted a different type of investor that needed to understand what was happening in the marketplace. So there was this evolution that needed to take place where people needed to learn about it, what's happening. And I think now we're getting to have more sophisticated investors come into the marketplace. And I think that's been really good for what's happening. So I think when we talk about this whole average raise side, I think it's important to raise a couple things. Um, That last slide talked about the average raise is well over 600,000. But the median raise, which is really typical, is about 185,000. Now, you have to look at this in the context of, well, the median raise in 2016 is very different from the median raise in 2025. Yes, the median raise has increased dramatically. But if you are an entrepreneur that is interested in raising money through investment crowdfunding, I think you need to look at the medians as a real an important gauge of what you can raise. This 185,000 shows you what the median raise is. Actually, yeah, that's not in 2025. That's among the entire spectrum, I think, from 2016 to t today. And so it should scope your expectations of what you can raise through this. It does vary depending on this next slide, which is the type of security that's offering. I really believe that there's a nuance here in regulation crowdfunding, and that is this is not one market. It's really two markets under one exemption. You've got debt offerings and equity offerings, and they behave completely different. They've got different investors, different issuers, and very different outcomes. And so many analysts and people just group everything together and say, this isn't working. People and companies aren't raising enough. If you take out the debt issuers, and I'm not saying take them out, I'm just put them in the silo that they should be in and separate them from the equity issuers, you're going to see that the average raises jump quite a bit. And that's what I try to get across in this slide right here. Um, the average raise in equity offerings, I think, is right around $800,000. Yeah, it says it right there in 2025. Debt offerings, on the other hand, are closer to 240,000. So why is that? Well, the companies that are raising debt capital through investment crowdfunding are smaller businesses, they're cash flowing businesses, they're mainly bricks and mortar type of entities that need a short amount of capital to help them do a specific project, open another location, buy inventory, something along those lines. And so and they also don't have the exit potential of many of these equity offerings. And so they're raising quite a bit less than the equity offerings. The equity offerings, on the other hand, are out there with an exit in mind. They have big markets that they're addressing. They've got big outcome potentials, and they need a lot more money to scale. And so when you are looking at this marketplace, I think it's really important to understand that you can't take it all at one. You have to break it down and look at it in the different aspects that it's in, from the companies that are pre to post revenue, from the ones that are established to startups, and like this, debt and equity. So I do think it's important, though, for us to take a look at, if and again, I'm sort of grouping everything together, but I can talk about it in this distribution of raises here. This chart shows you the shape of the marketplace. So when you look at the buckets here, this is the distribution of raise amounts. And the colors, the blue will tell you what is an equity, and the green what is a debt. And so what you can see clearly is these debt offerings raise a lot less and smaller, in the buckets themselves. Um, but the equity offerings also raise quite, they can raise a lot at higher bucket amounts. And I think that's where the key thing is. There's right now, there's relatively few raises that go over the $1 million mark, and a very small amount that exceed the 2.5 million. But it's really, really important, again, that you don't just put that in a silo, but that you actually understand, well, who are these issuers that are raising this money in these buckets? They're, in many cases, established companies that have been around, want to leverage their customer base and turn them into investors, or as we like to call them, investomers, and raise capital from them. And that we've seen those type of businesses really come into the marketplace over like the last 3 years. And so this again is another evolution of the type of issuers that are coming in and why they're coming into the marketplace, because they see that these smaller companies are able to do something that they weren't thinking about doing before, which is having these investors as not only people on their cap table, but really as brand advocates for what they're doing. And I think that's been a really important part for these companies because it helps them in a few ways. One, it gets them capital. Two, it gives them a marketing voice out there that capital in many cases can't buy. Three, venture capital in many times puts a lot of money into companies and says, spend that capital in marketing, and it doesn't succeed only because that can still be a limited amount of capital. But when you've got all these thousands of small investors out there that are, they've got a vested interest in the outcome of the business, I think that fundamentally changes what you have on your cap table. So, keep in mind, this is, none of this is designed to replace venture capital. This is filling a void that exists in a different part of the ecosystem. And I truly believe, and we've seen it with the companies that are successful with investment crowdfunding, is that you will graduate to a larger offering. You will graduate outside of regulation crowdfunding. You will move on to venture capital. You could do a Reg A offering and raise up to $75 million. This fills a need for many companies at a certain point in time. But I do believe that we can change that over time too. Now, if we look at the distribution by security type, like I was saying, debt will dominate the smaller buckets, equity dominates the larger ones. And this is where averages, like I was saying, can be deceptive, and underlying populations are very different. Now, let's talk about the investor participation. I think this is really one of the biggest achievements of regulation crowdfunding is it created this new class of retail startup investors. It leveled the playing field so that any average American can become a mini venture capitalist. The checks and the number of checks grew from about 20,000 in 2016 to more than 500,000 at the peak in 2021. Well, what happened in 2021? This was during that COVID period where we got a lot of money. We weren't outside. People were on their computers and they were investing. They were spending money that way. And so we saw that in the data itself. And in more recent years, the participation remains above 200,000 checks annually. This is a permanent change in the capital markets landscape. And I think what's interesting is if you take what was going on in that last couple slides where you saw what looked like capital receding over the last couple years, take a look at 2025 compared to 2024 here. You still have more investors in 2025 than there were in 2024. So what does that mean? That means that people are still interested in investing in these companies, even though there might be a pullback in issuers that think the timing is not right to be investing in them. So, what I tell issuers when I'm speaking to them all the time is I don't know if you should necessarily try and time the markets. If you've got a solid company with a solid team that's got great experience, if you've got a product that solves a problem in the marketplace for which people are willing to pay for that product or service, and you've been able to protect this somehow so that you can make sure that you can get money from investors and scale and achieve milestones, I think investment crowdfunding is right for you. So, I always tell people keep this in mind. This is not going away. This is evolving, and we're going to see more investors come into the marketplace over the next few years. Now, this next slide is all about valuations, and I know some people love to slam regulation crowdfunding because valuations are out of control. I point out all the time that valuations are 100% in line with what we see happening in the venture capital world anyway. So, again, when you talk in general terms, you're going to have a general response. I like to drill down into these four categories, which I think is very important, and I hope you can see. You heard me talk about startup versus established issuers. You heard me talk about pre versus post revenue issuers. You need to look at valuations in terms of those four different buckets when you are talking about valuations. Why? Well, because a company that is established and has got serious revenue and is scaling is going to have a higher valuation than a pre-revenue startup that is essentially an MVP for a product that hasn't proven that there's a customer that will buy it yet. And that's what I think these slides really lend to is help bring credibility to why valuations are where they are in this marketplace. They do change based on where you are. They are increasing over time, but I do take solace in the fact that if you're looking in this lower right-hand quadrant, the valuations, yes, they've gone up for pre-revenue startups. Over time, but it's still not in that 38.4 million area where you've got these established companies that are, I should say the 46.6 million post-revenue issuers that are established in the upper left-hand quadrant. So this is what I would just say. Again, post-revenue companies command higher valuations. Established companies, highest valuations. Median valuations are far more stable than the averages, and pre-revenue startups will have lower valuations. It has gone higher, but I think that is a conversation that issuers should be having with their prospective investors prior to going out for a Reg CF offering. I think when this industry started, and you can see it back there in 2016, the average raise or the average valuation for a startup, pre-revenue startup, was about 5 million. The fact that people are saying that it's 9 million now, I think is a tougher nut to swallow when you're an investor looking at a company that really hasn't proven that people are willing to pay for your product or service. But this is generally the trend where the market has gone. All right, so let me switch to this next slide. Do, do. Um, this one really talks about the success rates of companies over time. So this is the outcomes. The outcomes have dramatically improved since the early years. In the beginning, 48% of offerings were successful with a regulation crowdfunding offering. 75% was the highest, the peak. It's down to about 66% in 2025. So this is all due to, I think, again, people raising more, being smart about how much they need to raise. But I think there's a really important caveat in all of this that we need to talk about. And that is this hidden factor, which is the funding targets. And I talk about this a lot, and I think it's a pain point for the industry that we just need to be honest about. And I think perception-wise, we probably need to have issuers be more transparent about these minimum funding targets because they're set what I believe at are artificially low levels. I think the median funding target for many years was about $25,000. So if you set the bar very low, your success rates will naturally look high. And so when you looked at that last slide, if you saw high success rates and you're an issuer thinking, oh my God, my chances of succeeding are, very high. I like to put the caveat out there. Most of these companies are putting, lower funding targets. And quite frankly, I don't know what you can achieve if you got a $25,000 funding target with investor capital if you're trying to scale a company. So context matters. High success rates don't automatically mean high quality outcomes. If we go to this next slide, this really talks about what you as a founder need to keep in mind. That you need to be smart when you are going to market. You need to look at your security type and pick it from a strategic perspective, not an emotional one. You need to set those funding targets realistically. I know through our venture arm at D3VC, we look at deals all the time. And we pick apart these issuers when they've got these low funding targets because we're like, how do you justify that? And also valuations. If you have an insanely high valuation, but you haven't proven it, we want to know how did you come up with that? So be smart with your valuation when you're trying to come to it. There's a lot of tools and technology out there. We have a group that focuses on helping companies set the right valuations. So you also need to look at that. You need to understand where your raise is going to fit in the distribution so you can set your expectations properly And you know what? Like I said before, there's 150 platforms out there that have registered. Yes, there are the top platforms, but there are platforms that are better in certain areas. There's tools out there now that can help you figure out which platform is right for your raise. So you need to choose that platform strategically. So I tell people all the time, focus on the data. The data will help you figure out what you need to do. Now, if we could step back, and then I'm going to look at the questions and answer some of these too. Um, I would tell you that the big picture takeaways are this is no longer an experiment. We have proven that this market is here, that it can grow sustainably, that there's been very little fraud. There's been, what, one or two enforcement actions over the entire time span of the industry. The market, therefore, has matured dramatically. I would tell you that people need to be more responsible with their compliance when it comes to these offerings. You have a fiduciary responsibility to your investors. You have a legal obligation to the SEC. The law does say that you have to file updates to your offering halfway and at the end to let the commission know how much you are to your target and how much you raised at the end. It also states that you have to file an annual report with your investors until you terminate that annual report filing. But you have to do that for at least 3 years, I believe it is. And the compliance in that has been historically low. If you are not filing this, what happens is the SEC publishes reports on the state of the industry that doesn't show the true amounts that are being happening. So when I told you that the industry has raised $3.2 billion, I think there was a report that came out in April or so of last year where they missed $1.1 billion that we had captured that they didn't have because they didn't have updated forms from all of these issuers. That can be a problem when we want to ask the SEC for things that I'm going to talk about later on. But if I go back to just what I was talking about, we've got a different profile type of companies coming into the marketplace. They're older, they're more established, average raises have grown, equity and debt behave very differently. Take in mind that the median is much more honest than the average. And now investor participation is mainstream. The one thing that I want to talk about with regards to that is this is when you get an investor engaged in one of these offerings and they're talking about it with their friends, they're doing what this thing called is amplification. So they're not only sharing their personal experience with this industry we've created, investment crowdfunding, and these companies that they're investing in, but they're training, teaching other people about why they should be paying attention to this industry. And I think that is only going to scale over time. I think one of the challenges that we've had, which has just been, a frustrating point, I believe, for many of us in this industry, is the lack of media coverage that has taken place. You've got Shark Tank that gets all this coverage, which in many cases I believe is a farce. But now people are strategically using it just to get marketing attention, which I think is brilliant. But we need to get that same type of attention. We need to have the media having segments locally around the country that talk about the startups in their regions that are raising capital to engage other people in these businesses that are looking for capital. And I think that will increase investor participation as well. Now, where do we need to go? So I talked about improving compliance with Form CU and the annual reports. We have been active in writing letters, as Jenny said, it's all about communicating with DC to increase the cap from 5 million up to 20 million. We have conversations all the time with bigger issuers like, I need more than $5 million. What's the point of me doing several of these offerings or several small rounds when I could just do one round? I've got a huge base of customers to market to. And so we think the time is right to move it up to $20 million. I think that'll be really good for the industry in terms of bringing in less risky companies, again, larger, more established, more revenue companies. And these are the type of companies that are scaling. So they're at the part of they're at a really good part where you sort of want to get in because they've de-risked it by being around for several years. They've worked through the problems of starting and scaling their business. And now is a great time for them to open it up to you as an investor to come in and get in on that deal before further venture capital or they go public. So working on that. I think if we get the 20 million cap moved, we have to make improvements to the crowdfunding SPV to make it more workable and not trigger this 12G reporting, which forces companies to go public, essentially, if they have too many investors. Um, we need to make improvements to secondary trading and liquidity because you don't want to be stuck in these investments forever. I think Cedric and you guys over there at Silicon Prairie always talk about an investment without an exit is a donation. So I love that sort of response right there. We need to get tax incentives and rebates. Yes, we've got them, but we need better ones. The UK is far leading us in this. And as long as VCs have moved upstream, we need to allow early stage venture funds to crowdfund their funds. So it's currently not allowed in the system, but it's got to be something that changes. So that's it. I'm going to hand it back to you, Jenny, and we can talk about anything I've talked about.
Great. Yes, we did get a lot of questions. I do want to quickly mention for anyone who is interested in that advocacy work, Crowdfunding Professional Association has been doing a lot of advocacy, both with the legislators and the regulators. We have a 19-point policy list of policies we recommend. We regularly meet with legislators and people from the SEC. And the more members we have, the better our chances of actually having some success. We did get something passed in the House called the Invest Act, which was like it did address one of our requests. It still hasn't passed the Senate, but we're hopeful. So we are like little by little, maybe making some progress. So I hope you'll consider joining. Rose, I don't know if you'd be willing to put the link in the chat to join CfPA, but let's go ahead and see how many questions we can get to. So there was one question that someone put in the Q&A. Only everyone else put it in the chat, even though I said to put it in Q&A, so I'm going to reward this person. What are the 1 to 2 biggest obstacles you see today for the Reg CF industry to really break out and become more used by both investors and founders? And I think you kind of covered that, so if you could make that quick so we can get to some other more detailed questions.
Yeah, I mean, it comes back to awareness. I think, this industry does not get the coverage that it deserves. I think if more of the media outlets, more of the news outlets covered it, that would be more awareness of what's happening, and it would help bring more issuers to the table and more investors to the table.
Cool. And I think you did answer Evangeline's question about the difference between the smaller companies and the larger companies. Mark asked, oops, we're scrolling. Can you explain what you mean by parallel investment?
Yeah, sometimes when we're talking about this, we get very technical. So I do apologize for that. Jenny made a reference to this at the very beginning. When the Jobs Act was passed, um, crowdfunding was Title III, but there were other titles in there. Title II was called accredited. What was it called? It was the 506C one. It's a general
Forget what it was
solicitation for
called.
accredited investors. Um, and essentially, if you think about it, that allowed crowdfunding for accredited investors because before you could not solicit investors in any way for private investments. And so that changed it from that 506B to a 506C. And what also happened is we were through the evolution of this industry, you could do concurrent offerings. And a concurrent offering means you can have two offerings, a regulation crowdfunding offering happening over here and a 506C offering happening over here. It's the exact same offering, but they're called two different things. This one has accredited investors only in it. This one has mainly retail, but it can have accredited investors in it if they only invest through the Reg CF side. So when I talk about the parallel offering, it's those offerings that are doing both those at the same time. And you see that really in the offerings that raise over the $5 million Reg CF cap. They're doing concurrent rounds and they're raising, another round with accredited investors.
Yeah, back in 2017, I raised for a nonprofit and we raised, I think, 400,000 under Reg CF and another 700,000 with 506C.
Yeah.
Okay. Paul Lovejoy asks, secondary markets are coming to Reg CF. In 2025, IPOs raised about 171 billion. Meanwhile, the New York Stock Exchange alone sees roughly 80 billion in secondary trades per day. None of it funding companies. Exactly, Paul. It's a lot of people don't realize when you invest in the stock market, you're not funding a company. How do we prevent Reg CF from becoming a friendlier Wall Street? Yeah, because Reg CF is supposed to be about capital formation, not about just trade, 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 create yet another casino. I love this question, obviously, as you can tell. From Reg CF investors allowing their capital in Reg CF secondary markets instead of capital formation.
I mean, Jenny, I'd love to hear your opinion on this too. But here's the thing. I think if there's one thing I've come to realize about this marketplace is there's just a lot of logic in it. And I believe that I'm not worried about the secondary marketplace for regulation crowdfunding only because I truly believe there will only be a market for those companies in a secondary market that actually have proven that there is both investors willing to buy and sell those securities, and a company has hit milestones. So if you haven't achieved the milestones that you set out to, you're not going to have any liquidity for your company on a secondary exchange. So I'm not worried about that. I think by the way, Paul, only a small fraction of the companies that raise through Reg CF will ever be a potential for a secondary market. So if it, I just don't think it's going to be a big issue because I think the logic is going to prevail, and it'll keep the bad, ones from trading.
Yeah, I tend to agree. I think the chance that there would be a super active secondary trading market for Reg CF investments is low in the next decade or so. So I'm not super worried about that. There's so much that needs to be done to make Reg CF better. If you look at our list of 19 things in our advocacy agenda, even those are probably just half of things that we would like to see. Those are the things our board like strongly agreed on. Um, a secondary market is just one thing. It's actually not on our advocacy agenda, although I will say it is part of the Improving Crowdfunding Opportunities Act, which hasn't passed either the House or the Senate, but it has been floating around for a few years, to make that easier because right now, one of the challenges with it is state law. There's no, just as Woody mentioned, the NASA folks, the state securities regulators, they like to get their hands on these things. And so that makes it really hard to have a secondary market. And they're lobbying hard to make sure that they can continue to have some say over how that works. So we only have a couple minutes left. Oh, there is another question. What are your thoughts on the SEC's comments about lack of investor protection in the equity crowdfunding space? It seems to be the go-to pushback. I don't think the SEC has actually said that. The one thing they have said, and Pierce, I'm curious to hear what you're talking about. I think what you might be referring to is the comment about the lack of reporting that's been happening, the people not complying with the post-race reporting. We did get a comment about that from Commissioner Peirce. CfPA is actively working on that issue, trying to raise awareness about the reporting requirement. In fact, we had a webinar last month all about that. And we're also advocating with the SEC to make it easier. Right now, if you try to do your post reporting after you raise on your own, you're probably not going to be able to figure it out. It's super tricky. And so you have to hire someone to help you. There are some services out there that are only a few $100s, but I think it's absolutely ridiculous that you can't just go on some website and do your report. By the way, you do have to have GAAP compliant financials for your annual report. You only have to do one annual report in most cases. So you file your one annual report and then you file this form called CTR, which is your termination of reporting requirement. So it should be so much easier. You shouldn't have to pay someone to do it. We are advocating with the SEC on that topic. We've, directly, we have a good relationship with Commissioner Peirce and have spoken with her about that. Of course, they move slowly, but there hasn't been a better time since I've been involved in this space to advocate with the SEC. They're way more open to hearing from us than they've ever been in my experience. So please join the CfPA if you want to help us with advocacy and be part of our visits that we make to the Capitol. You've got to be a member, and it's very affordable. All right, I think we need to stop there. We're a little bit past time, but thank you so much, everybody. Thank you, Paul. You're the best. We love you. Paul's on our board. All
Paul.
right, bye.
Everyone, thanks, Jenny.